Hey everyone, this is Dr. Allison. Welcome to this week's video lecture. Tonight we're going to cover the topics of global capital markets and foreign exchange markets. So let's get into it. So what are global capital markets? A global capital market is the interlinking of various investment exchanges around the world that enable individuals and entities to buy and sell financial securities on an international level. So quite frankly, it's taking the investments and exchanges between two countries or more and making it work between the individuals and entities to buy and sell those financial securities. A capital market is an organized market in which both individuals and business entities, and consider this as pension funds or corporations, for example, they also sell and exchange debt and equity securities. This market is a key source of funds for an entity whose securities are permitted by a regulatory authority to be traded, since it can readily sell its debt obligations and equity to investors. Governments also use capital markets to raise funds, typically through the issuance of long-term bonds. Governments do not issue shares and so cannot issue equity securities. So keep that in mind. Governments cannot issue shares and they can also not issue equity securities. What's really important to understand about this is that global capital markets can raise funds, though, in the issuance of long-term bonds. This is how they raise money for long-term projects, to do business between two foreign companies, or to find ways to borrow money without having to issue shares or equity stock. A capital market is intended to be for the issuance and trading of long-term securities. When a publicly held company sells its securities in the capital markets, this is referred to as primary market activity. The subsequent trading of a company's securities between investors is known as secondary market activity. So again, primary market activity is when a publicly held company sells their securities in the capital markets. But the trading of those investments and company securities between investors is secondary market activity. It's very important to distinguish those two. To help shape further what a global capital market is, here's some examples. Examples of highly organized capital markets are the New York Stock Exchange, American Stock Exchange, London Stock Exchange, and NASDAQ. Securities can also be traded over the counter rather than in an organized exchange. These securities are usually issued by entities whose business fundamentals, such as revenue, capitalization, and profitability, do not meet the minimum standards of a formal exchange, which forces investors to use other avenues to trade the securities. So we've all heard of the New York Stock Exchange, NASDAQ, American Stock Exchange, and London Stock Exchange. In fact, daily, the news will tell you if stocks are up, how the NASDAQ's performing, because that measures the health of both the U.S. Currency, the U.S. markets, but also from a global aspect. Global market trade can happen within the New York Stock Exchange and NASDAQ, especially companies that are international. They really do partake into these types of exchanges. However, if a certain company or organization cannot meet the fundamental standards of the New York Stock Exchange or NASDAQ, for example, they do more over-the-counter or more, let's say, informal means of trade between the two business entities. Capital markets are highly interconnected, so a disturbance in a capital market on the other side of the globe will likely impact trading in markets located in other countries. For example, when something happens, a devastating event in one country, and they do a lot of business in other countries, it can impact the global market. For example, on 9/11, when that occurred, the global market was impacted by this. There was a lot of uncertainty about what was going to happen with, the airline industry and also trade and goods and services. Things like that impact the global market because of the fact that countries rely on each other to do business. If another major war or, political shift or some type of economic shift occurs in one country that's doing business with another, especially through some type of formal exchange program in a global capital market, other countries are affected by it. And you see that when it comes to access to supply, access to funds, or prices going up or going down depending on the gravity of what's going on. The last bullet there says the Securities and Exchange Commission, the SEC, is an example of a federal level agency that regulates the reporting of information by any entity that wishes to issue securities in the capital market or have its securities traded in a capital market. So basically think of the SEC as the police of what's going on at a federal level when it comes to the exchanges and securities issuances in the capital market. They're making sure that things are being processed legally, that there's a fairness going on between the countries, and that there's no major issues taking place that's going to impact the global market, or at least the countries involved in a particular trade. Global capital markets have evolved over the recent years, and one research conducted by the McKinsey Research company suggests that a global capital market is forming, one that moves capital efficiently across national borders to meet demand in other parts of the world. The research they conducted indicates potential for a coincidence of needs between developed and developing economies that can promote prosperity for both. So remember we talked about one lecture, the difference between a developed and a developing economy. A developed economy is one that has a developed set of companies and economic currency, and jobs are jobs are plentiful, or at least have established themselves in their market. Where a developing economy is developing, they have some issues when it comes to employment, or they have some issues in their banking industry, things of that nature. So what they're saying here in this research is that capital markets are going to provide an avenue of prosperity to both developed and developing economies. Part of the research too talked about capital demand and supply. Developing countries can grow rapidly if they are able to attract the necessary capital and know-how. Global capital has flowed to countries that not only pursue policies that enhance the economic and a political environment for business, but also develop a good financial policy and infrastructure. So what this is saying is that global capital markets have influenced not just, how developing countries operate from an economic and political environment, but they're also helping build this infrastructure where there is, a better market appeal for those developing countries, for companies to come in and do business, where trade and exchanges of currency are becoming more prevalent and easier to operate in. The McKinsey research looked at the global capital market and said while the markets for money, foreign exchange, and bonds have already become global, the equities markets are only now in the process of globalizing. Moreover, as bank deposits continue to be securitized around the world, more and more of the flow of funds in the economies of the developed world will be instruments which can be traded and thereby linked directly to the global capital market. And then, as we continue looking at the research recently conducted by McKinsey on the current state of global capital markets, potential outcomes and implications for policy. What they found is that higher household saving rates of an aging developed world will likely increase financial assets being channeled through a mature, integrated global capital market to the best opportunities in the world. MGI also sees the potential for the global capital market to act as a powerful check on the tendency of governments in the developed world to issue debt to fund increased consumption in the form of entitled programs. So basically, when we're looking at higher household savings rates, the more developed countries around the world, the savings rates for certain individuals is starting to increase. More and more individuals going into retirement, or at least the younger generations that are looking into retirement, are trying to find better ways to save for the future. Developed countries have more individuals who can save than developing economies. In developing economies, a lot of people are just trying to get by, or there's more poverty stricken areas of a developing economy, whereas developed countries or developed markets, individuals have means to save, which is going to help the global impact as a whole. So now the next part of this lecture is going from discussing global capital markets to now foreign exchange market. The foreign exchange market is the market in which participants are able to sell, buy, exchange, and speculate on currencies. Foreign exchange markets are made up of banks, commercial companies, central banks, investment management firms, hedge funds, and retail forex brokers and investors. And when you see forex, just think of that as being foreign exchange. While there's all types of players involved in the foreign exchange market, the main participant of this type of market are larger international banks. What this means is that in financial centers around the world, they function as anchors of trading between a wide range of multiple types of buyers and sellers around the clock, with the exception of weekends. Part of this is currency exchange, and they're always traded in pairs. The foreign exchange market does not set a currency absolute value, but rather determines its relative value by setting the market price of one currency it's paid for with another. For example, one US dollar is worth X amount of dollars, pesos, or other types of currency around the world. So dollar for dollar, $1 in America could mean another amount or value with another country. This is all based on the relative value within a country of their currency and how it relates to another. So it's when you travel, as you know, you have to trade your currency in for what the current value is in that country, and that value changes based on the dynamics of a foreign exchange market. The foreign exchange market works through financial institutions and operates on several levels. Behind the scenes, banks turn to a smaller number of financial firms known as dealers. These dealers who are involved in large quantities of foreign exchange trading. Most foreign exchange dealers are banks. So this behind the scenes market is sometimes called the interbank market. Although a few insurance companies and other kinds of financial firms are involved. Trades between foreign exchange dealers can be very large, involving hundreds of millions of dollars. Because of the sovereignty issue when involving two currencies, Forex or foreign exchange has little, if any, supervisory entity regulating its actions. So this is a very special case where there's not a lot of regulation going on, that in this interbank market, things are taking place. This type of dealing occurs between foreign exchanges. However, one has to ask the integrity in some of the exchanges, and also if they're not being monitored correctly, what is going on behind the scenes. So that's why it's very important to understand the bank you're working with, the financial institution, to make sure that they are truly vetted out, they are trustworthy, and in some cases SEC approved. Expanding further on what the foreign exchange market is all about, the foreign exchange market assists international trade and investments by enabling currency conversion. So the foreign exchange market again takes the value of a dollar in one country like America to another country based on a variety of factors. For example, it permits a business in the United States to import goods from European Union member states, especially Eurozone members, and pay euros, even though its income is the United States dollar. So we can take one currency type and say this is what's going to make profit or generate revenue, and translate that back to the home country's currency type. It also supports direct speculation and evaluation relative to the value of currencies and the carry trade speculation based on the differential or interest rate between two currencies. So there's interest that can be accrued based on time and the dealings in that foreign exchange market. In a typical foreign exchange transaction, a party purchases some quantity of one currency by paying with some quantity of another currency. Today's modern foreign exchange market began forming during the 1970s. This followed 3 decades of government restrictions on foreign exchange transactions under the Bretton Woods system of monetary management, which we talked about last week, which set out the rules for commercial and financial relations among the world's major industrial states after World War II. But after that, countries gradually switched to floating exchange systems from the previous exchange rate regime, which remained fixed per the Bretton Woods system. So there are various characteristics of the foreign exchange market. 1, its huge trading volume represents the large asset class in the world, leading to high liquidity. What this means is that there's a lot of exchange going on between countries on a regular basis, around the clock like we talked about. It consistently is the largest asset around the world. The exchange that goes on between multiple countries at any given time is what creates a global viewpoint of the value of all the different commodities and exchange values across the world. Its geographical dispersion, really what this means is that there's not one set of foreign exchange that's going on between 1 or 2 countries that is, dominating the entire global aspect of business. There's so much going on at any given point that there's multiple countries doing business with one another, that there's not just one geographic area that's driving all the business. And it's 24 hours a day. It happens all the time except weekends. There's people working in Wall Street right here in the United States at the New York Stock Exchange or NASDAQ, just 24/7, looking at their stocks, monitoring it, making sure that they're in the moment. It's all about being in the moment, especially when it comes to stock exchanges and NASDAQ, making sure they understand the impacts going on around the world, working with countries that are in a different time zone. That's why it's that important for someone to have the stamina to work in these environments, because it could change in a moment's notice. There are a variety of factors that affect exchange rates. We know that based on, we talked about before, political, economical, or just other impacts that impact one country affects another. Another characteristic of foreign exchange market is the low margins of relative profit compared with other markets of fixed income. So just because we're making exchanges in one country doesn't mean that both countries are profitable or they're making margin. Some countries benefit greater in their profit gain than the other country they're working with. It just depends on the scope of the deal and the exchange. The last characteristic to discuss is the use of leverage to enhance profit and loss margins, and with respect to account size. A larger company doing business in one large country could gain profit and more profit than the smaller company that they're doing foreign exchange with or business in another country. It's a trade-off. Where's that profit gain and loss? And that has to be, evaluated within a foreign exchange market. So we've talked a lot about how foreign exchange rates occur, what's going on, how we talk about how foreign exchange market is 24/7, that you're working with countries from all over the world in different time zones, that there's not one region of the world, there's not one country dominating in the foreign exchange rates. It's because it's so big. According to a survey back in 2016, this particular survey you can read in the PowerPoint, who conducted it, that on an average day in April 2016, so fairly recent, on an average day of that month, $5.09 trillion was exchanged in the foreign exchange market across the world. Think about that. $5 trillion per day is being exchanged in some way in currency across the world. Multiply that by 7, that's 35 trillion a week, and you can do your math from there to make sure to see how much that is per year. But that is a lot of money, a lot of exchange going on around the world. That's why it's so hard to pinpoint at any given moment where the main whether there's no one country that's driving all that. There's no one foreign exchange between two entities causing that. It's a very global thing. It's huge. It's measuring the entire world's exchange based on the various rates. Even though it did come down from 5.4 trillion in April 2013, it did gain from 2010. So again, if you look at the years there, 2010 came off the recession in the United States, and while it did drop in some significant matter back in 2010, it has gained some speed in the recent years because the global economy has been in better shape in recent years. Now, if you take that average day from April 2016 and how that $5.09 trillion breaks down on an average day, here's the type of exchanges that's going on that makes up that $5.9 trillion. $1.6 trillion of that is in spot transactions. $700 billion of that is in outright forwards. $2.4 trillion of that is in foreign exchange swaps. $96 billion of that is in currency swaps, and $254 billion is in options and other products. So it's a wide variety of different exchanges going on at any given point, or currency exchange as well. So overall, I hope this provided some overview for you on global capital markets and foreign exchange markets. Watch the videos this week and read the chapter as well to get more information on, how this affects, how the global market and how we had defined that, how it affects overall doing business in the global aspect. Thank you for your time this week, and I will speak with you soon.